Let's kick things off, folks. Thanks for joining us. Today, we're going through our third quarter review. So kind of all the discussion items today are looking back on what happened in the third quarter and hopefully a little bit of guidance on what we see going forwards and how we're planning for things. We're doing this one live via Zoom. So there's also the open questions. If you type anything in there, we'll be able to see it and we will be able to answer that or hopefully answer that and address it in this conversation that we're going to have. We have a couple points that were pre-submitted and also questions that came in from our third quarter reports that we sent out. We send those out on the 20th every day after the end of the quarter. So we're going to touch base on some of those first. And then at any point you have questions, just type them in and we'll get things going. All right. You want to do the first one here?
Sure, I can do the first question. So the first question was around annual inspections and why do we do annual inspections at our triple net properties when in fact the tenant is responsible for all maintenance to the property? Well, the answer to that's pretty simple. Number one, we need to make sure the tenant is complying with their lease, make sure they're not doing anything and anything inappropriate, making sure that they don't have any deferred maintenance. So if something needs to be fixed, a roof leak, some type of crack someplace in a building or a parking lot, it's all fixed. And we're in the position to say, hey, this is a little bit of a deferred maintenance item. You need to fix it. So we do these annual inspections just to make sure the tenant is actually complying with their lease and making sure they should be doing what they should be doing. Because, you know, in the end of the day, it is our building and we're responsible for it. And we want to make sure the tenant is taking care of it. So that's the very simple answer.
Yeah,
that one.
I mean, not only are we doing them, but all of our tenants are required to have a certificate of occupancy. So the city or whatever municipality we're in is going to make sure that they have that certificate of occupancy. And a lot of times that comes with an inspection of the physical premises. So not only are we doing it and with us going through and looking at the properties, but the city is going to come through and look at those as well. And that's kind of when you start hearing if things have code violations, that's because someone went through an annual inspection and they didn't pass part of it. And the city is saying, you now have to update this or change this. A lot of, I mean,
some of our tenants are like Dollar General, 16,000 units. And sometimes they just will miss something. And so they might actually appreciate, hey, you have a little bit of a problem here. You might want to address this. For example, a leaky toilet or a toilet that is running water 24 hours a day.
They'll look at everything.
Somebody might want to know that. It's not our responsibility, but somebody might want to know.
Yeah. And, a lot of times buildings that we're buying, we are buying stuff where they either haven't had a CO or they've got a lot of code violations, like Park Hill, they had 4 3-inch binders of code violations when we purchased it. And that was a long time ago. And for us, that's a great opportunity.
They were waiting for us for what, like 7, 8, 9 years to show up.
They're like, we've been looking for you guys. Thanks for coming. And then it gives us opportunity to fix things. So we've run into that frequently, but all the time we're going through this inspection process. I we got one question that came in here. So like we had a flood at one of our properties, not a flood, but it was next to a flood zone and the river overflowed and it went into the parking lot and got into some of our lower units. So is there a concern that the deal will struggle to pay expenses with potentially hit cash flow because of the flood? So one thing we implemented really about 5-6 years ago was requiring 100% of our tenants to have flood insurance on the residential side. And so that covers their lost goods. It covers hotels. It gives them, I think, $5,000 per occurrence. So all of our tenants' interior items are covered from that situation. So it's not an ideal situation. You never want to have that happen. Certainly displaces and causes pain for residents. But thankfully, now that we have a policy where all of our residents are insured and they either have to provide proof of that insurance or we buy it for them through our operating platform. So we don't have a situation ever where people are uncovered, which really helps. So that's any tenant that has any damage, they're covered in that situation. Yeah. Here's another good question. If they just leave and there's no rent coming in, we'll have to re-rent the property. We're frequently dealing with turnover. If turnover goes below 50%, that's when it's a challenge for an asset to make distributions. But as long as we keep occupancy high and we have retention, and if we lose a few units because of that, it's like, yes, we'll have to make repairs and release them, but that's not necessarily a something we haven't done before on a property.
And isn't there, some type of loss insurance, rental loss insurance on that?
We do. We have rental loss insurance,
Right.
but in that situation, we didn't lose enough to say, hey, we should go use our insurance.
Right, above a certain amount,
I mean, we're still gonna have to pay the deductible. It's not like
right?
$250 car deductible. It's like ours are typically $25,000, or if we can get higher deductibles, it really helps bring down our insurance costs. And insurance costs are rising rapidly across the US.
Second
So,
highest expense on an apartment complex.
yeah, other than taxes. Yeah.
Yeah.
So, okay, we'll move on to,
We got a good one for the second one.
yeah, you want to go on to the next question that we got
It
in?
was about Midtown sale. What's happening with?
No, it's
Oh.
leasing activity.
Leasing activity.
So it's like, what does it take to lease vacant commercial space right now? So,
Yeah, so in general, when we're looking at our vacancy in our buildings, what we found is kind of the sweet spot is 2,000 to 5,000 square foot units that are move-in ready. So we try to, put new flooring in, paint them, and make sure that they're kind of designed in a way that fits the normal business, meaning that there's some ratio. Say if it's 5,000 square feet, there's 4 or 5 offices and a conference room and then common area. So we try to make those move-in ready as frequent as possible for that tenant, for that kind of ready to move in tenant that we are really targeting. They really don't have the time or the vision to go and rebuild a space, or come into a blank space and say, hey, I want all these things. They just want to move in and get going. So that's really what we're targeting and going after.
yeah, we've had a couple new leases this quarter as well. Yeah, the second quarter we had some very big leases. We were signed 20 and 40,000 square foot leases. In this quarter, the largest leases we signed were between 3,000 and 6,000 square feet. And a lot of times we get questions on what type of tenant do we have in our space. It's pretty frequent. And this time we had some of the bigger ones were logistics companies. We've signed a lot of those leases,
especially
recently.
in Chattanooga.
In Chattanooga, yeah. This is another, our largest lease this quarter was up in Chattanooga, up at the Midtown deal. So 6,000 square feet to a logistics company there.
And they took it move-in ready, and we were able to relocate some of the cubes that we've inherited from our recent purchase and help them basically build out their offices. So that worked out pretty well for them and us.
We have free cubicles for anyone that would like one.
We have a free, like a building full of cubicles.
Yes.
We could have
200 plus cubicles.
Well, I think half of our cubicles are gone out of Forum. We bought a recent deal, Forum Flex, and it came with maybe 200 cubicles. And I think we've got about half of them either repurposed or gone so far. So we're making progress. We still have some more to go.
The other big lease we had was Carolina, one of our tenants. It's a furniture company, and they took the first space at our Graham property in Charlotte. So one of our QOZ properties that we looked at selling, and then the sale didn't go through. So we had to focus back on leasing this year, and we got our first lease there. So we're very excited about it. 3,200 square feet, and they took it as is. They just moved in and they set up a wood shop, and it's great.
Yeah, and that's like a flex, high ceiling, open floor plan that they just moved right into. So a lot of the stuff we're trying to do is enable us to be able to say yes to a tenant so they can move in quickly. Open spaces that we do have, if we're looking at stuff, the Forum deal we just bought a lakeside office. These are old office layouts that we're opening up and converting to flex and trying to get that sweet spot of sometimes it's 2 to 4, sometimes it's 3 to 6, but we're looking at smaller spaces. We get higher rents in those situations. We're typically getting leases that are in that 3-year time frame on a smaller square footage, but they lease pretty quickly once we're there. I guess, yeah,
sale in Midtown. Talk about that a little bit. How does that process work?
Yeah, this has been an interesting deal since we bought it. It took us a long time to get this deal under contract. It took us a long time to close. It is large. It's 280,000 square feet total. It's up in Chattanooga, and it's a number of different buildings. It was hard to kind of peg a value in that situation too, because some are occupied, some are vacant. And we took 2 of the buildings that once we purchased, we got everything into stable financials. We implemented our common area maintenance. We've talked about that in past quarters, where it's like, how do we go in and enforce the terms of a lease? So we did that here at Midtown. And now we have 2 buildings that we mentioned in our quarterly report that are for sale. They're under contract, and they're scheduled to both close prior to the end of the year. And we are confident we're going to be able to get them closed, but it's going to be it's a, what do you say, conversation with the bank on how this situation plays out. We've got the loan and we've got the tax component. So let's talk about the loan part first.
Yeah. So the loan, they give us one loan on the whole property. And as we sell off building by building, it's basically a partial sale. So they need a partial pay down of the loan. And the bank has to basically reconcile how much of the sale proceeds will go towards that partial pay down. So every time we sell a building, we basically have to reappraise the remaining of the property to make sure the collateral of the asset services the loan for the bank. And this is just checking things out for the bank. We knew this going into it. I don't think we understood how difficult it was going to be. We thought it would take a kind of a 2 to 3 week lag, but it's taking more like maybe a 5 or 6 week lag.
Yeah. The one offer we had, we were selling a medical building. We accepted the offer and they said, hey, we'll close in 10 days. We're like, yes, this sounds great. All cash, no debt, good purchase price, but it's going to take the bank 40 days to do an appraisal. So we are now, we're waiting for that, to happen with the bank. So banks are obviously slowing that component down, but we still have a good buyer. We're still excited about exiting 2 of these deals. And we expect, because we don't have an answer yet because we don't have the appraisal back yet, but we are expecting that the proceeds from these 2 sales will just be used to pay down debt on the asset.
And so we've talked about with a couple of the investors is, will there be a capital gain from the sale? Our basis are around $80 a square foot. We're selling for around $130 a square foot. And the way that basically these 2 buildings we're selling are fully occupied. The other ones are not. So we're from a tax standpoint, those have higher value. So all the proceeds will basically go against the basis of those buildings. So we'll basically push that gain forward into future buildings as we sell them.
Sure.
The incentives, what type of incentive negotiations do we go through on commercial leases right now?
So if we think about the leases that we're trying to sign, and our best situation right now is with these shorter leases. And we're talking about like 2 to 6, 3 to 5,000 square foot range. And what we're seeing is they're willing to pay a little bit higher per square foot price than a large layout, right? Larger gets a little bit of a discount. We're seeing about 1 month of free rent. Typically it's called a concession rent in the commercial space. It's really just a month of free rent for every year that you sign. So if they sign a 3-year lease, we're going to give them 3 months of free rent. And our going in strategy where we have these suites ready to go is that we offer less TI. We're trying to do it as capital efficiently as possible.
Yeah,
so that gives us 10 to 20 a square foot.
Yeah, when we buy these buildings, we try to make the move-in ready to begin with, and then we'll offer, and that making them ready to begin with usually costs us around $10 to $20 a square foot. And then when the tenant comes and they want specific needs, or maybe they need just more furniture, and they need some help basically with the move, we can offer them somewhere between $5 and $15 more towards, or maybe a little bit more free rent depending on how much cash we have available.
Yeah. A question that came into like which medical buildings. Not sure which ones specific to a property, or
we were talking about the Midtown property had a couple medical buildings, if that's what the question is.
Yeah. We're selling one of the buildings in Midtown up in Chattanooga is a medical building that's tied to that portion. It has a medical tenant. The other one is not a medical tenant that we're selling up there. It's a commercial kitchen training and store location.
Yeah, the tenant's buying it.
Yeah, the tenant is buying that one. But is there something more specific too we could answer on that, or the build outs that we're doing right now are not medical based either. Our typical medical build out is not even remotely close to $10 or $20 a square foot. They're hundreds of dollars a square foot to get a specific medical user in there. We have one lease we're negotiating right now in going through with our tenants up in Duke Medical. And that's a substantial build out. If you're looking at building out lab space, it's different kinds of numbers that those tenants are putting in to the building. And most of the time that build out costs more per square foot than the buildings cost. It's normally more.
I mean, we're giving them close to 100 a square foot, and they're going to bring double or triple that on top
easily,
of that.
Easily. Yeah.
And so it's an incredibly expensive tenant to acquire.
Yeah. But also that's the space they need to operate in.
Exactly.
Their price points are different than a $10 to $20 square foot flex user.
Right.
So we want to go to next here. We got
Next one,
That one's,
Rate impacts on apartment deals, interest rates increasing. How is that infecting the apartment industry and apartment transactions right now?
yeah, specifically in our case, and we haven't looked at an apartment deal in years now.
2019.
Yeah. So
Yeah.
we've talked some just about how things got too expensive for us and we have not been able to find a way for them to work. Right. The returns just weren't there, especially the cash returns on any kind of new build. So I think we can see kind of what we're seeing in the market though. What the main opportunity, if anything, we buy things that aren't working very well. So for us to have an opportunity, that means something has to not be working really well. We like the single story office right now because it's not working very well and we can buy it and repurpose it. And we feel like we get a discount on a good price. So for us to get it back into apartments, it means some things have to be not working very well for us to get excited about it. And what we see that isn't working really well is a lot of the new construction. As those deals have come out of the ground, we kind of had two things that happened together. So over the past 2 years, inflation and the hard costs of building stuff have gone up significantly, where the construction costs of new multifamily is 300,000 a square foot more, especially in some locations. If we look in the Southeast, 300 is not a crazy number anymore. We were looking to buy stuff for 30.
Right.
So we're like, there's a big gap of like to fill in there, but you had construction costs that went way up and now you have interest rates that have gone up. So a lot of times you look at a deal where people spend a whole lot of money for that deal and the yield just isn't there. Now with higher rates, that deal is underwater because the higher rates mean that it's not worth as much anymore from a purely cap rate valuation on the revenue it's generating. So there's a lot of more recent deals that are probably underwater on construction costs. So I would say value under construction cost, which, you rewind 12 years ago, 15 years ago, we're like, how do we buy apartment deals that are under replacement cost? That was a great metric to be looking at.
Well, if you just oversimplify it, if you build a house for $500,000 and the house is only going to sell for $400,000, that just never works.
Right.
And then those, if there's 50 of those or 100 of those or 1,000 of those, it creates a pretty big problem for the owner and and also the bank too.
Yeah. So
Yeah.
I think some of those deals will start trading coming into 2024. There's not been a whole lot of, some of the previous conversation we've had too, like overall deal volume is down tremendously. We've heard upwards of 80% from different brokers, like, volume kind of fell off a cliff with rates going up like this.
And with the negative leverage environment, meaning that if you're to buy a 5 cap rate new multifamily project, but your cost of debt's going to say be 6.5%, and rents aren't growing as fast as they were. There's a lot more concessions, like 2, 3, 4 months of free rent. Deals are becoming much more sensitive to, and prices are becoming much more softer as a result of it, specifically in the higher end space.
Yeah. So there should be, on that front, if there's some opportunities to buy stuff at below replacement cost in the near future, we would certainly be more interested in seeing what that looks like. So question that came in here, how is rising interest rate environment changing your willingness to sell existing properties earlier than your original timeline? Right now, we're always willing to sell something if we get the right price. A lot of times we were looking at deals and we're like, hey, we're going to hold this one. We get a great price. And we're like, now we're selling it. So we position ourselves as a group that wants to hold long-term and generate cash flow. So we see most of our deals sticking with that mentality where we'll be holding and trying to improve margins, trying to work on cash flow and continually making that better. Right now on the apartment side, our first loan comes up in December of 2025. Everything else is after that. So we have
A little bit
for the most part, a good amount of fixed rate debt that we've put in place prior to 2 years ago on all of our residential assets.
And, so part of this is where interest rates are today. And a lot of especially in the apartment world, is tied to the 10-year treasury and the spread on that. A little bit what we were talking about earlier is the lack of competition in the space with just really almost no new banks starting, and the existing banks really have no competition or no force to compete on rates. And it's not helping the interest rate environment either.
Yeah, we've got, I mean, this is kind of a little bit of a side where we got an interesting chart. We're going to put that up. It just kind of shows like the banking environment where there's a whole, over the past, I think it was like 7-8 years, there have been almost no new banks that have been started. Right. So you see this chart here between 2000 and 2007. It's like, you got like 100+ banks created every year. And then there was essentially zero.
For a very long
Two.
time.
There were two between 2011 and 2016. And now we see a little bit of that coming back, but not much activity on the new banking front. So you've really had a consolidation of banks as a lot of them have been bought up and kind of merged into these much, much larger banks. And that's where, for us, we are not a great customer for a large bank because we're too small, but we're kind of in the middle for a regional bank or a smaller bank.
Right.
So it means that also just means that there's less lenders out there looking to place debt, and you have rates going up, making it harder for them as well. The rates rose. Pretty sure this is the fastest that rates ever rose. I'm pretty sure.
Well, 3.5% to 7.5% in pretty much
I'm just
a
talking.
year.
I'm not talking about the actual Fed rate, like how fast that one went up.
Yeah.
Which is just uncertainty for banks. And if they're lending money in that environment, they're like, wait a minute, is it going to do that again? Or is it going to go down? Or,
Yep.
They don't necessarily have a crystal ball either. So I think it puts them in a less likely
It'd be
to
nice to
land
go
position.
down that quick again next year.
I think
I thought that'd be healthy.
any move up and down that drastically is kind of just crazy. So
So that, do you want to answer that or?
sure. Yeah. So a question coming in here. This is one of our office buildings that we have is, can you speak to how Johnson Square is trending? And do you expect this to start producing enough cash flow to fund full preferred quarterly distributions? So Johnson Square is 92% occupied right now. And again, this is an asset that has ready to go suites. So it's easy for people to move in there. So it is 92%. The places we've had trouble with renting it does have some upper floor space, and those have been harder to rent than the ground floor, single, you walk right in the suite and you're there, not having to walk upstairs makes it, more attractive on that front. From a cash flow and cost stance, we've spent a lot of money recently on just lease renewals and signing spaces. When we put together a pro formas on these, we call out like, hey, how much is going to be needed in reserves for leasing commissions, tenant improvements, the building. And at Johnson Square, we had significant amount of dollars that were sitting in that bucket. I believe it's $2 million that we spent their total budgeted for that. But that doesn't necessarily mean we capitalize all that. A lot of that stuff does get expensed. So our expenses right now are ahead of where we want them to be because we're spending a lot on the TI and leasing commission. So as that slows down, then we should be in better shape on a purely cash flow, whichever we want to call it, after expenses or after CapEx, to make distributions to get fully caught up there. We need to be at about 95% to make our full quarterly preferred distribution. And we need to be able to do that without having a lease renewal, a significant one in that time frame. So it's going to ebb and flow as we stay in that band. Our goal is not to be 92%. We do want to push and get to 100%. A lot of times you look at the market, this was even from our very early days. It's like, hey, 95% is great. You're doing a good job. It's like, well, there's still 5% left. Like if we just get that extra 5% on everything, that's a huge win. So we will keep pushing there and trying to lease and do everything we can to get to 100%, not just stay at 92%. And 100 is really where we can make even additional distributions from it.
Right. So that's a good transition to kind of this last point, which is how we're, right now we're, in hunker down mode. Like let's operate, let's produce cash flow, and let's make these properties work. Because the exit is just not super viable right now for the majority of the portfolio, and which is fine. It's, we're operators. So let's talk about how we look at operations. And
yeah, we'll put this next chart up pretty quick. This one, this has a lot of numbers on it, and you might be like, what the heck are we looking at here?
More focus on the trends.
So we want to point out two specific lines, and it's the yellow line that's kind of in the middle. You can see one yellow line on the top is going up and one yellow line on the bottom is going down. So this is a chart where going up is better than going down. But what we're looking at here is a metric we're going through internally, which is really basing our operating return on assets. So we want to take an existing asset. We know what we paid. We know how much equity we have in it. We know what's there. How much free cash flow are we generating from that investment? And the one on the bottom here, this is an apartment deal that we recently sold. And you can see the yellow line is our return on equity on an annual basis. So back up to 2020, this was a deal that was performing very well. You can see it had 15% return on equity. And this doesn't mean it was fully distributed. A lot of times we earn money and it goes into reserves or it stays on the books. It's not always distributed. So this is making 15% a year in 2020. Then 2021, 2022, you can see it starts declining 11.6, 6.6%, all the way down to just under 3%. And we sold this deal in 2023. This was West Side Crossing.
Yeah, West Side Crossing.
What did we sell? I mean,
Sold it for what?
we
110 a door?
oh yeah, but I'm saying like we sold it for like a
A 4.1.
4.1,
Yeah.
4.1 cap rate. So we sold this deal in our mind at an excellent cap rate at a time when our returns were going down. You see that the top line is revenue. So we had 15.8% revenue against our assets. So that means if we had $100 asset, we generated $15.80. And that grew over time. It grew up to 17%. But our margins were just got eroded away on that specific deal because of some of the challenges we were facing with operating it. And that's why we exited. So we're using this to help determine that exit position. Now, if we look at the top deal, we say like willing, one of the previous questions too is just like willingness to hold deals or not necessarily sticking to an exit timeline. If we can see charts like this top one, where we can see the gray line, the revenue growth as a percentage of asset value was pretty close to the deal that's on the bottom chart. But on this top chart, you see our deal return on equity and the free cash flow from it going higher and higher. So we saw an expansion of our margins here because this deal is one we've been able to operate it for many years and it's continued to perform well. We're maintaining our occupancy. We're able to maintain our retention. And therefore we see a deal that performs well. So this top chart is East Side Crossing. So
this is a deal we continue to hold, continue to invest in, and continue to enjoy the fruits of our labor with this, upward trending.
Yeah, the return on equity is continuing to improve. And you see all the numbers on the bottom that are there as well as we look at some debt pay downs and
any questions on this? It's a lot to digest,
but we'll do another one on this and explain more because we look at this across all of our assets to say, what decisions are we making on how our assets performing on a purely financial basis. So it's kind of that one's a little bit of in the weeds chart. It's a fun one and it helps us really have a transparent, like, are we doing well or are we not doing well when we look at an asset? They say like numbers don't lie. So those numbers definitely weren't lying to us as we saw margins almost, they were getting crushed at West Side Crossing. Our expenses were rapidly growing and East Side Crossing would continue to perform well and expand our margins and improve our operations. So that's the reason that we're holding that one. So, okay. So question on the charts right here is, do you intend to include them in the reporting? And so you can also see the trends. It's a good question. We try not to put insanely detailed charts into there that require a kind of verbal conversation. It's hard to do on a written format, if that makes sense. In our charts, we have our revenue numbers and we have our expense numbers. This is just a net of those tracked on an ongoing basis over years. We can certainly send you these so you see what they look like. But we do this assessment each quarter for each property. And it's really how we're making our financial decision of buying or selling and holding and what our budget numbers look like as we plan those out for the year. So I guess short answer is we don't necessarily intend to change or include, more charting in our quarterly packages that go out.
Yeah, but we have the information if you're really.
Yeah, we're happy to
you're
go
really
through it and look
interested.
at it as much as you would like, though. Yeah. Can you speak more on West Park and the surprise FBI tenant leaving? Yeah, so West Park has
Secret
I think
Service,
it's Secret Service, FBI,
and then some others.
yeah, but those are the only two federal government ones. Yeah, so those are both like done through GSA leases, and yeah, we were not expecting the FBI to say that they were leaving the space, so that was definitely not in the business plan for that location. We are talking with the other tenants there, especially the other GSA Secret Service tenant, to see if they would like to take the space that they have there. So we're still working through what that is fully going to look like, but we don't have any kind of further down the stream information as to what ultimate decision will come out of there if GSA is going to keep that for another 10. So GSA, Government Service Agency, just that's normally our leasing contact for a lot of our federal government tenants is handled through the GSA, and they control a lot of the leasing that's done on any federal building. So are we planning to sell any more residential properties? Right now, our mode is to hold and operate. It's not a great market to be selling in because there is uncertainty. Of all the debt markets out there, residential is probably the best, though.
Mhm.
Right?
Yeah, because you have Fannie and Freddie that will take out the loan and it's back.
Yeah,
to
so
loan.
they're
Yeah.
still there. So we don't have any more plans immediately to sell residential, but we're always a sucker for a good price.
Yeah, right.
So if they're
we had no plans to sell most of our residential that we've sold over the years
correct.
until the sucker. Yeah, until we
got the
became
offer.
suckers.
Yeah.
Yeah,
yeah,
for the
if
good
it's,
price.
if it's a good price, we'll hand deliver keys.
Yeah.
So did they give any reason for leaving the FBI? The FBI was looking at consolidating locations but again, this is coming from
Layers.
layers of, I think, not necessarily direct reporting either, but layers of, kind of whisper down the alley that they'd be moving to another location that they already have. So that's not a great answer. That's kind of what we have. We're looking at the fact of like, we have the space coming up. We're assessing what will we need to put in to the FBI location to make it attractive. So it could be move-in ready for someone. And then the other part is talking to the GSA and the Secret Service to see if they're would be willing to take that space. And certainly office leasing isn't the greatest right now. I don't think that's a surprise to anyone, but we're still actively signing office leases. We're still having move-ins. We're still seeing traffic. So, if we position things correctly and we have the right packages, we still feel confident we can get tenants into places. Yeah. See if we have any other.
What was it? Topics, I think.
Oh, one other thing here. The FBI has another location just up the street. Oh yeah, so they might be consolidating. Yeah, that was what the word was that we heard, but also this was not like a direct, FBI person telling us this. This is through the chain of lease administration. So, good question, you yeah. If we look at our timeline for taxes and kind of how they flow.
Repeat it. So
Yeah, he doesn't-
Yeah. Oh, okay. So question here was, there were a lot of questions or comments on our cover pages about our tax prep services and K1 timelines and what that looks like. So the question was to dive into what is that schedule and why were there additional costs in the third quarter when we do taxes in essentially the first quarter. So our overall tax timeline is we finish our financials around between the 5th and the 10th of January is when we finish financials here internally at Greenleaf. And we turn that stuff over to our CPA to work on all of our K1s. The K1s, we try to send everything out as a bulk together. And it's dependent upon when the states allow us to finalize returns. I think it was this last tax cycle, it wasn't until March 1st that North Carolina said we could submit. So the earliest we can get everything out was March 1st based on K1s. We have the information, but we still have to be able to submit it for each state. So once we get that done, we then file our returns and we send everyone their K1s, and then that all the K1 reporting, everything that comes back, eventually the holding company entities that are the general partnerships for the deals. We don't file our returns until October 15th. So it takes us a while to wrap up that full cycle. And the 2021 tax bills, I think we even filed later that year from October 15th. Those tax bills, we didn't finalize all of them until that point. And then we didn't even start paying them until into, we filed those end of 2022. We paid those in 2023. So this year when we went through, we're like, hey, we want to make sure we're caught up on everything. We paid all of 2021 and 2022. We just did it all at one time. So we don't necessarily run those on we're going to file the taxes in the first quarter and pay our tax accountant bill the first quarter because we don't have it at that point. So it takes a while to get through the system and get through them. But we should have paid 2021 earlier, but we didn't. No, so we already did the 2020. So the question was, is that can be the same for follow-on years? And no, because we already did the 2022 ones that we have. So
Caught up.
When we go into, our next tax cycle, we'll be paying 2023 bills in 2024, which we will do around March to April of 2024. So you'll see those in the second quarter statements of 2024 for 2023 tax prep. Correct. Yeah. So billed annually and most likely paid in the second quarter each year. So
We have some questions that came in, Dave.
so
early thoughts on Forum Flex.
Yeah, after a month of ownership. So Forum Flex is rocking and rolling.
Yes.
We
did some demo last week.
We had some fun last night.
we had a little event last week where we got to we get questions on who are our tenants. So we had a investor event where you could meet and tour the tenant space that we had. And it's a pretty cool facility where they're assembling LED panels that you can wrap them around poles or build a 400-inch
giant buildings. Yeah. Or the Braves ball they made.
They've got some really cool stuff, indoor and outdoor use that they assemble there at Forum. So they're a great tenant. They're there. The remainder of the space, that was when we were joking. We had 200 cubes. We're down to 100. We'll probably have the next 100 out here fairly shortly. And we have almost all of our demo. We're about halfway done with demo. We'll be fully done with demo in about 4 weeks.
Yeah. So
we'll have everything stripped down, and then we'll start back by dividing into the 3,000 to 5,000 square foot suites. So it's going fast and it's going very well to start with.
Yeah. We have basically 2 tenants that are there, and we were in their space last week. The other one wants to expand to double their space, and the third one we're negotiating whether they want to stay or not.
Yeah,
and it just quickly turn the space.
We had planned on them leaving. There's one tenant, 2 that are there. The one is expanding. A third one is maybe going to leave, but we were expecting them to leave and demo that space.
Yep.
So, but overall positive and moving quickly, which is great for the market right now. So next question is, what acquisitions and asset types are you focusing on? Right now, I mean, the best opportunities we're seeing is single story office that we can convert into flex. With that, we get a good number of benefits. The parking ratios are normally very good, so you can convert the building so you can still get trucks in there. They have very good power supply, because if you think about an office, it's got a lot of computers and it's running a lot of stuff. So we typically have 480 power coming into an office. So that's sufficient for industrial use, and it's very good power. You think if you don't have enough power supply, you can't run any heavy pieces of anything, which is common at a flex building. So we feel good about that usage. And typically we had about 14-foot ceilings.
Yep. Yeah. So along those lines, we have our next acquisition that should go out this week. It's a 35,000 square foot flex building. It's really right in our operating box and our buy box. But the exciting part is that we got the seller to finance it back to us at 6% fixed debt. So it's about 200 basis points lower than the market is right now. So we're excited about that opportunity. And then we still have a little bit of room left in our one of our restaurant deals that well, you know, these restaurant deals right now, because of where interest rates and cap rates are, the best opportunity is really to find an operator and partner with them and basically make a win-win, that we have a space in a building that they want and they want to stay there long term. We create a long-term lease under terms that work for everyone, and can have good cash flow going forward. So both those opportunities will, one has been out, and we'll send a final reminder out for that one because it's just about fully funded. That's the restaurant one. And then the future flex one will go out this week for you to take a look at.
Yeah. Anything?
Well,
Any other,
Upton.
yeah. But
Yeah.
any other deal?
Oh,
I mean,
sorry.
well, there's another question up here. We'll touch on the debt side of stuff
Yeah.
too. But so updates on Lupton and leases, right? So, I mean, we finally got our CO on this assets in the opportunity zone fund, and we have LOIs that we're negotiating, but nothing that's a moving fast, ready to move in situation.
Yeah, the building is downtown Chattanooga. Downtown Chattanooga has just had some issues, especially around the building, with a little bit of vagrants and you know, a little bit of crime activity. Nothing that we're super worried about long term. It's just really a micro issue. And so we're going through and kind of putting new security measures in, gating off the alleyway, putting in facial recognition scanners and access points for the building. And we feel like it's going to market the building. We have a bunch of LOIs that we're negotiating right now, but they wanted to see how we were going to secure the building. So we're showing them, and then we're hopefully going to convert some of those LOIs into leases.
Yeah. And that security system is a pretty cool platform that we have. It's cameras. We can all of our members of our operating team can see all the cameras for all of our assets on their phone, and it can buzz people in and out, and you know who is exactly is coming and going. So we think that's going to help on the selling front with those LOIs.
Yeah.
Next question here is, how are you investing your cash reserves? And the only thing, well, one, we're a real estate investor group, so we're not investing cash reserves into anything really. We have money market accounts that we're putting any of our free cash, and as much as we can. So the cash we do have held is in interest-bearing accounts.
Wait, Dave, what about all that Bitcoin we bought last month?
Yeah, I don't know if that's up or down, but
It was free Bitcoin.
Yeah, exactly.
free Bitcoin.
Yeah.
We I must have missed that one. But we our interest rate now is we're getting in the mid 4s on the banks that we do have cash reserves with. So it's paid monthly. If you know, on any of the financial statements we have, you see interest income that we're putting on the financial statement. So really just in money market accounts that are tied to each specific property. Any update on private credit opportunities? So yeah,
we're looking at some opportunities to buy notes and service them. They look pretty attractive, and it is mostly in the single family residential world, and buying really a collection of them and making a portfolio so basically we can pull together a bunch of investors and invest into a portfolio notes. We think we'll have that underwritten and put together really in the next 30 days or so. So there'll be more to come on that one.
Yeah. And we've been looking at different hard money lending options. Either doing it ourselves or investing in groups that do it, or is it buying notes, or like, it was very tight maybe 4 months ago. And before that, it was like, it wasn't something we really saw a lot of margin in where you could make some money doing it. And now we think that, you know, some of the hard money loans are getting out there mid double digits. So like 15% interest that are going out there. And it's a little more attractive now.
Yeah, and because of the lack of liquidity with exiting the notes, a lot of these notes are 10-year notes. They've been seasoned for 1, 2, 3 years. With the lack of liquidity to sell those notes to other people, their margins were so good when they put those notes in service. Yeah. They're willing to sell these notes to, say, us for 30, 40, 50% discount of face value.
Yeah. Understanding a little bit of the credit markets too, and we're by no means the expert there, but lenders are lending money out, and then they also need to then recapitalize that so they can lend out more money. So they're looking to bring in loans and then they sell it. So a lot of times on the real estate investing side, when we're working with banks, we're frequently asking them like, hey, are you holding this loan on your books, or are you syndicating a loan out with other banks, or are you going to sell the note to someone entirely differently? And the answer a lot of time is very different on how each bank provides us with a loan. So just like they're providing us with a loan and they may go sell it, we can kind of go around the other side of that and say, look, if banks need to sell a loan, or a private credit group needs to sell a loan, could we buy that loan at a discount? So that's really the opportunity where we've been discussing with most right now with people.
And we're really filtering it like service light. I mean, there's not a whole lot of servicing going on on our end, and also low risk of foreclosure, meaning that the note's been seasoned for a decent amount of time. It's not just a brand new note put in service.
Yeah. So, okay. Please figure out the possibility of a sale of TVTC, and is this likely? Right now, TVTC is, I think we are 99% occupied there. So we are full. All the tenants have CAM reimbursements in place. We have rent escalations in place. Again, we're always willing to accept top dollar for something, but right now we do not see that as a option at TVTC. We spoke to some brokers on this, not in a hey, we need to sell this right now, but like, hey, we're okay, but you want to bring us some offers and see what we can do. And for the most part, the guidance was not to try that right now.
Yeah.
So we'll probably hold, operate. You know, the issue we do have at TVTC is that we have a significant reserve number there that the bank is unwilling to release to us, and they're unwilling to pay us interest on. That's, you know, when we got this loan 5 years ago, interest on reserves was not a significant conversation point in the loan, and on their loans, they do not offer interest on reserve accounts, and they require us to hold those reserves at their bank, and they control whether those reserves are distributed or not. And they're not distributing reserves, and they're not paying us interest on it. So one of the thoughts was if we can refinance it to free up those reserves, but that's probably not worth spending the money to spend a couple $100,000 on a new loan there.
Yeah, and we have or I think 4.1 fixed for another, I believe 5 years.
5 more years.
It was a 10-year fixed loan.
So the loan has a bunch of positives in that it's a long fixed rate period. It's a 4.1%. It's a good loan. It's just our opportunity cost of not earning money on the interest that we have in reserves, which is around $1.2 million right now. So we're losing, in theory, you know, just over
$40,000 a year, $50,000 a year
of opportunity cost by having that. So, yeah. All right, well, that was all the questions we had that came through. We'll hang out for a minute here if anyone else has anything else, but appreciate everyone tuning in and listening here. Hopefully this is helpful, gives you some clarity on any issues going on with properties or different points that you want to know. So thank you for tuning in. We'll leave it open for a minute or two here if anything else comes up.
Don't you have your own exit
music?
You have exit music, and you also have the phrase now, I thought.
Oh, we don't have exit music.
I thought he was working as exit dance the last
No
time.
exit dance.
Yeah.
Because
But
it
it's a little
was
bit-
starting.
But eventually we're just going to go back to work.
Okay.
So, all right. I think that's it, folks. Everyone have a good rest of the day.
Thanks for
Thank
showing
you.
up. Thanks.
For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.